Right now, three quantum computing companies are sitting at the center of a multi-billion-dollar bet, one that could define the next era of computing, or wipe out a huge chunk of investor capital trying to get there first. Last week, all three stocks surged more than 20%. This week, we're going to break down exactly what triggered that move, what each company actually has to show for it, and what needs to happen next for this rally to be real. If you've been anywhere near the stock market over the past year, you already know these names: IonQ, Rigetti Computing, D-Wave Quantum. Three publicly traded, pure-play quantum computing companies that have become some of the most talked about, most traded, and most polarizing stocks on Wall Street. They don't move like ordinary technology stocks. They move like lottery tickets. A single headline about a government contract, a research breakthrough, or a new partnership can send these shares up 10, 20, even 30% in a single trading session. And the reverse is just as true. A skeptical comment from a tech CEO, a disappointing earnings report, or simply a broader market pullback can wipe out weeks of gains overnight. That's exactly what happened heading into this past summer. After a strong run through the spring, all three of these quantum pure plays got hit hard. IonQ slid from a high near $69 a share all the way down into the low 40s. Rigetti dropped from the mid-20s into the high teens. D-Wave slipped from the high 20s down into the low 20s. On paper, that's a brutal stretch. Investors who bought near the highs were sitting on losses of 20, 30, even close to 40% in a matter of weeks. Forums lit up with the same tired argument that's followed this sector since it first came into the public markets, that these are overhyped, overvalued companies riding a wave of speculative enthusiasm with nowhere near the revenue to justify their valuations. And then, almost as quickly as it fell apart, it turned around. Over the span of just 7 trading sessions in early August, all three stocks came roaring back. We're talking gains of roughly 20% or more in a single week across the board. Not one company having a good run while the others lagged behind. All three moving together, snapping back hard enough to erase a meaningful chunk of that summer sell-off in the blink of an eye. If you were only glancing at a stock ticker without any context, you'd think there had been some massive scientific breakthrough that changed everything overnight. The reality is more layered than that, and understanding it is the key to understanding whether this rally has real legs, or whether it's just the latest swing in a stock sector that has become notorious for these kinds of violent mood swings. Let's start with the bigger picture, because context matters enormously here. Quantum computing, as a technology, is still fundamentally in its early stages. We are not talking about a mature industry with predictable revenue streams and established competitive moats. We are talking about a handful of companies racing to build machines that exploit the strange rules of quantum mechanics, machines that use qubits instead of traditional bits, machines that can, in theory, solve certain types of problems exponentially faster than any classical computer ever could. The promise is enormous: drug discovery, material science, financial modeling, logistics optimization, cryptography, both breaking it and rebuilding it to withstand a quantum-powered future. These are the kinds of transformative use cases that get investors excited enough to pour billions of dollars into companies that, in some cases, are generating only a few $1,000,000 a year in actual revenue. That gap between the size of the promise and the size of the current business is exactly why these stocks trade the way they do. When sentiment is positive, when there's a new contract announcement or a research milestone, investors race to price in a future that might be a decade away. When sentiment turns negative, when a prominent tech executive says quantum computing that actually works commercially could still be 15 or 20 years out, the air gets let out of the balloon just as fast. This is a sector that trades on narrative and momentum as much as it trades on fundamentals. And the past week is a perfect illustration of both forces working in the bull's favor at the same time. So what actually happened? Let's go company by company, because each of these three stocks had its own specific catalysts layered on top of the broader sector-wide enthusiasm. Start with D-Wave Quantum. Of the three, D-Wave has arguably had the most consistent string of positive headlines. The company reported first quarter bookings that were simply staggering, a record $33 million, representing growth of roughly 2,000% year over year. That number was anchored by two very real, very large contracts: a $20 million system sale to Florida Atlantic University, and a $10 million quantum computing as a service agreement with a Fortune 100 company. Those aren't hypothetical future deals. Those are signed contracts, real dollars, committed by real institutions who believe D-Wave's annealing-based quantum systems can already do useful work today. On top of that, the company's remaining performance obligations, essentially the backlog of contracted revenue still to be recognized, climbed to over $42 million, up more than 500% from a year earlier. Then came the research news. Just this past week, D-Wave published peer-reviewed research in the journal Nature. demonstrating dual-rail qubit gate technology with roughly 99.9% fidelity in two-qubit entangling gates. In plain English, that means the company showed it can perform certain quantum operations with an extremely low error rate, which is one of the biggest technical hurdles the entire industry has been racing to clear. High-fidelity gates are the foundation for building larger, more reliable quantum systems. And having that kind of result published in one of the most respected scientific journals in the world gives D-Wave a credibility boost that goes beyond typical corporate marketing. And then there was the NASDAQ Verafin news. D-Wave announced a partnership tied to financial crime detection technology. And that single announcement sent the stock up 11% in a single day. Stack all of that together, the record bookings, the Nature publication, the new commercial partnership, and you start to see why D-Wave rallied more than 32% in that single week. Wall Street noticed too. Wedbush initiated coverage with an outperform rating and a $40 price target, one of several bullish calls that landed in the same window. Consensus analyst targets on D-Wave now sit north of $37, well above where the stock was trading even after the rally, giving bulls a straightforward argument that there's still room to run. But here's where it gets complicated, and this is important, because no honest breakdown of this story can ignore it. D-Wave's actual quarterly revenue was just $2.86 million, and that figure was down 81% year over year, largely because of a tough comparison against a big system sale from the prior year. The company is trading at a price-to-sales ratio in the hundreds, an extraordinarily rich valuation by any conventional measure. And operating cash burn ran roughly $45 million in the most recent quarter alone. This is a company that is spending aggressively to build out its technology and its commercial pipeline, and the market is betting heavily that the bookings and the backlog eventually convert into real, recurring revenue at scale. If that conversion slows down, or if a future quarter disappoints, the stock's high valuation leaves very little room for error. Now let's move to Rigetti Computing, which had its own set of catalysts, most of them tied to government policy rather than pure commercial deals. Rigetti signed a letter of intent for up to $100 million in potential CHIPS Act funding, spread over 3 years. For a company with a relatively small revenue base, that kind of federal backing is a meaningful vote of confidence, and it plays directly into a larger theme that's been building all year, which is Washington's growing urgency around quantum computing as a strategic technology, particularly in the context of competition with China. Lawmakers have been pushing for significantly increased funding for quantum research, and executive orders have directed federal agencies to accelerate deployment of research-grade quantum systems by 2028. Rigetti, as one of the few domestic, publicly traded quantum hardware companies, is positioned to be a direct beneficiary of that kind of policy tailwind. On top of the CHIPS Act news, Rigetti also joined the NSF-funded Tangle Lab project alongside HPE and the Pittsburgh Supercomputing Center, another signal that the company is deeply embedded in the broader ecosystem of academic and government-backed quantum research. And on the hardware side, the company's newest system, a 108-qubit machine called Cepheus 1, is now generally available across multiple major cloud platforms, including Rigetti's own quantum cloud service, Amazon Braket, Microsoft Azure Quantum, and Q-Braid. 2-qubit gate fidelities on prototype systems have reportedly reached as high as 99.9%, putting Rigetti's technical benchmarks in the same conversation as its larger, better-funded competitors. Financially, Rigetti's first quarter revenue nearly tripled year over year to $4.4 million. Still a very small number in absolute terms, but a meaningful growth rate. And unlike some of its peers, Rigetti is sitting on a genuinely strong balance sheet, with $569 million in cash and investments and zero debt. That cash position matters enormously in this sector, because it buys the company time. Quantum computing is not a business where you flip a switch and start generating massive profits. It's a long, capital-intensive race, and companies that run out of cash before their technology matures simply don't survive to see the payoff. Rigetti's cash cushion is one of the strongest arguments bulls make for staying patient with the stock. Wall Street responded accordingly. Wedbush initiated coverage on Rigetti with a $40 price target, and Benchmark launched coverage with a buy rating and a $25 target, both landing in the same window as the broader rally. The stock climbed nearly 27% in that single week, riding the combination of policy tailwinds, a fresh batch of bullish analyst coverage, and genuine technical progress on its hardware roadmap. The risks here are also worth being upfront about. Company insiders sold roughly $17.5 million worth of stock over the trailing 90 days, which is the kind of detail that tends to make momentum investors nervous, even if insider selling doesn't automatically signal a lack of confidence. Trailing 12-month revenue sits at just $10 million, which underscores how early stage this business still is relative to its market valuation. And because Rigetti reported earnings shortly after this rally, any miss against expectations had the potential to unwind a meaningful chunk of the week's gains almost immediately. It's also worth pointing out that Rigetti's story is a useful case study in how government-driven catalysts work in the sector. Unlike a commercial contract, where a company negotiates directly with a paying customer and revenue tends to follow a fairly predictable path, federal funding announcements often come with longer timelines, additional approval steps, and conditions that can shift as political priorities change. A letter of intent for CHIPS Act funding is a meaningful signal of confidence from Washington, but it is not the same as cash already sitting in the bank. Investors betting heavily on Rigetti are, in effect, betting that this policy support continues to build over the next several years, even as budget priorities, election cycles, and competing national spending demands evolve around it. Finally, there's IonQ, which stands apart from the other two in one very important way. It is, by a wide margin, the revenue leader of the group, and its most recent earnings report was nothing short of a blowout. Second quarter revenue came in at just over $80 million, up nearly 287% year over year, and comfortably beating Wall Street's expectations by more than 20%. That kind of growth, at that kind of scale, relative to its peers, is exactly the sort of result that gives investors confidence the company's commercial pipeline is converting into real, durable revenue rather than one-off system sales. Management didn't stop there. They raised full-year revenue guidance to a range of $280 to $290 million, a significant upward revision that signals real confidence in the trajectory of the business heading into the back half of the year. IonQ also closed its acquisition of Skywater Technology at the end of July, a move that expands its manufacturing capabilities and vertical integration, something that matters a great deal in an industry where hardware development and fabrication capacity can be just as important as algorithmic breakthroughs. And the company's cash position remains enormous relative to its peers, sitting at roughly $1.24 billion, giving it substantial runway to keep investing aggressively in both research and acquisitions. The company's chief executive described it as the strongest quarter in the company's history. And given the size of the revenue beat and the guidance raise, that's a hard claim to argue with on the surface. IonQ stock had already been up nearly 25% in the week leading into the report, and the earnings result added further fuel, pushing the broader rally across all three quantum names into a genuinely coordinated, sector-wide move rather than a single company's isolated good news. But even IonQ's story comes with a significant asterisk. The company posted a gapey net loss of $1.87 billion for the quarter, a staggering figure, though it's important to understand where that number actually comes from. The bulk of it was driven by fair value changes related to warrants, essentially accounting adjustments tied to financial instruments rather than operating losses from the core business. Still, headline numbers like that tend to spook less sophisticated investors, and stock-based compensation for the quarter alone totaled nearly $142 million, a reminder of just how much dilution shareholders are absorbing as this company scales. And because the stock had already run up so much heading into the print, some analysts have pointed out that a meaningful portion of the good news may already be priced in, leaving less room for the kind of explosive follow-through that often characterizes earlier stage rallies in this sector. So, stepping back, what do we actually have here? Three companies, each with a distinct narrative, all rallying together in the same 7-day window. D-Wave offering the widest gap between its current share price and where analysts think it should be trading, backed by a genuinely explosive bookings number, but still carrying very thin actual revenue and an eye-watering valuation multiple. Rigetti riding a wave of government policy tailwinds and a rock-solid balance sheet, but still operating at a scale where a single disappointing quarter could meaningfully shift sentiment. And IonQ, the clear commercial leader of the group, delivering the kind of revenue growth and guidance raise that would make almost any growth investor take notice, but trading with the least remaining upside to analyst targets after its own explosive run. It's worth zooming out here and putting this rally in the context of how this sector has behaved over the past year. Because if there's one lesson that keeps repeating itself with quantum computing stocks, it's this. These moves rarely happen in isolation. They rarely happen just once. Go back to earlier in the year and you'll find quantum stocks soaring after a major tech company announced a breakthrough with its own quantum chip, only to come crashing back down weeks later after comments from prominent technology executives cast doubt on how far away truly useful, commercially viable quantum computers really are. Jump forward a few months and you'll find another spike, this time triggered by a defense contract announcement, followed by yet another pullback, driven by broader macroeconomic concerns like interest rate expectations. Move forward again, and there's a spike tied to executive orders directing federal investment into the sector, followed almost immediately by a pullback once investors started questioning what those federal commitments would actually translate into in terms of real, near-term revenue. The pattern is remarkably consistent. A catalyst hits, whether it's a scientific milestone, a government policy shift, a large contract win, or a blowout earnings report, and the entire sector moves together, often disproportionately, to the actual financial impact of the news itself. Then, once the initial excitement fades and investors start scrutinizing the underlying fundamentals more carefully, a portion of those gains tends to evaporate. This isn't a criticism of the technology itself or of the companies building it. It's simply a reflection of how a highly speculative, narrative-driven sector behaves when it's still years away from generating the kind of steady, predictable cash flows that typically anchor a stock's valuation. That context matters enormously for anyone trying to figure out what comes next after this most recent snapback. The most important thing to understand is that betas across all three of these stocks are extremely high, ranging from roughly 2 to as high as 3.3. In simple terms, that means these stocks tend to move 2 to 3 times more dramatically than the broader market in both directions. When the market is euphoric about growth stocks and speculative technology, quantum names tend to outperform significantly. When risk appetite shrinks, whether due to interest rate concerns, broader tech sector weakness, or simple profit-taking after a big run, these stocks tend to fall harder and faster than almost anything else in the market. That volatility cuts both ways, and it's exactly why this sector has become a magnet for both aggressive momentum traders and long-term believers in the underlying technology, while remaining largely avoided by more conservative, risk-averse investors. So what actually needs to happen for this rally to prove itself as something more durable than the last several spikes that eventually faded? A few things stand out. First, the bookings and contract momentum that companies like D-Wave and Rigetti have been touting needs to keep converting into recognized revenue on the income statement, not just headline-grabbing press releases about backlog and remaining performance obligations. Investors have shown they're willing to be patient with early-stage revenue figures as long as the trajectory of bookings and contracts keeps pointing sharply upward. But that patience has limits, and if a future quarter shows bookings growth slowing down or contracts slipping in timing, the market has proven repeatedly that it will punish these stocks quickly and severely. Second, the technical milestones need to keep coming, and they need to keep being credible. The quantum computing industry lives and dies by benchmarks, whether that's qubit counts, gate fidelities, error correction thresholds, or peer-reviewed research published in respected journals. Every one of these three companies has leaned heavily on technical progress as part of its investment narrative this year. And any sign that progress is stalling, or that a competitor, particularly one of the larger technology giants with far deeper pockets, is pulling meaningfully ahead, could shift sentiment away from the smaller pure-play names in a hurry. Third, keep a close eye on the broader policy environment. Government funding, whether through the CHIPS Act, defense contracts, or direct federal investment programs, has become an increasingly important driver of sentiment in this sector throughout the year. That's a double-edged sword. It provides real near-term capital and credibility for companies that still generate relatively little commercial revenue on their own. But it also means these stocks are now more sensitive than ever to political developments, budget negotiations, and shifts in government spending priorities, factors that are largely outside any individual company's control. And fourth, watch interest rates and the broader risk appetite across the technology sector as a whole. Because these are largely unprofitable, cash-burning companies valued heavily on future growth expectations, they tend to be especially sensitive to changes in the interest rate environment. When rates fall, or when the market expects them to fall, speculative growth stocks like these tend to get a disproportionate boost, because investors become more willing to pay up for cash flows that might be years away. When rate expectations shift in the other direction, or when broader market volatility spikes, these are often among the first stocks to get sold as investors rotate toward safety. There's one more angle worth exploring before we get to the final takeaway, and it has to do with how retail investor psychology interacts with all of this. Quantum computing stocks have become a favorite among retail traders precisely because of their volatility. The same price swings that make institutional investors cautious are exactly what draw in traders looking for fast, dramatic moves. Social media chatter, options activity, and short-term sentiment indicators all tend to spike alongside these rallies, sometimes amplifying the moves well beyond what the underlying news would justify on its own. That retail enthusiasm can be a powerful short-term tailwind, pulling more buyers into the stock and reinforcing the upward momentum. But it can also reverse just as quickly, because retail-driven rallies tend to be more fragile than moves built on steady institutional accumulation. When the mood shifts and profit-taking begins, the same enthusiasm that drove the stock up can accelerate the fall on the way back down. That dynamic has played out repeatedly across this sector over the past year, and it's a factor worth keeping in mind any time one of these stocks makes a sudden outsized move in either direction. Put all of that together, and here's the honest, balanced picture of where things stand. This past week's rally was not built on nothing. Unlike some of the sector's earlier spikes, which were driven almost entirely by sentiment and speculative enthusiasm, this move was underpinned by genuinely strong underlying developments. Real record bookings numbers at D-Wave, A credible, peer-reviewed research breakthrough, meaningful government funding commitments at Rigetti, backed by one of the strongest balance sheets in the sector, and a genuinely spectacular earnings report at IonQ, with real revenue growth, a raised guidance range, and a strategic acquisition to boot. That combination of catalysts, all landing in the same tight window, is precisely why the entire sector moved together so forcefully. At the same time, none of the structural characteristics that have made this sector so volatile over the past year have gone away. Valuations remain extremely rich relative to current revenue, particularly for D-Wave. Actual commercial scale profitability remains years away for all three companies. Betas remain elevated, meaning any broader market wobble is likely to hit these stocks disproportionately hard. And the sector's own history over just the past 12 months shows a clear, repeating pattern of sharp rallies followed by equally sharp pullbacks, often within a matter of weeks. So where does that leave investors trying to make sense of all this? The most reasonable takeaway is that this rally deserves to be taken seriously as a reflection of genuine operational progress across all three companies, not dismissed as pure speculative froth. But it should also be approached with the same caution that's been warranted every other time this sector has surged over the past year. The fundamentals are improving, the revenue growth at IonQ in particular is genuinely impressive, and the government and institutional backing flowing into this space continues to build. But the valuations still assume a great deal of future success that hasn't happened yet, and the sector's own recent history is a clear reminder that these gains can disappear just as quickly as they arrived. The next few months will likely tell the real story. Watch how bookings convert into revenue. Watch whether the technical milestones keep coming. Watch how government funding commitments actually get deployed. And watch how these stocks respond the next time the broader market gets nervous, because that reaction, more than any single week's rally, will reveal whether investors truly believe the quantum computing story has turned a corner, or whether this is simply the latest chapter in a stock sector that has made a habit of soaring, stumbling, and soaring again. For now, the numbers say this week's move was real, backed by genuine bookings, genuine research, and genuine revenue growth. But in a sector with this much history of giving back its gains just as fast as it earns them, real progress and a durable rally are still two very different things, and only time will tell us which one we're actually watching unfold.